We spent a lot of time in sort of the first 45 minutes of the program today talking about what's happening overseas and U.S. Treasury market reaction. I want to focus a little bit on corporate credit and the outlook in 2026. Carol mentioned some of the sort of the busyness that we've seen already this year, but what is the outlook on corporate credit right now?
Yeah, I think we would say it's the same red thread we've seen over the last 3 years in corporate credit, and that is the resiliency of American companies and the debt that they're issuing. Even all the way down into high yield, you're seeing, lower or average default rates. People can count on the fundamentals of these firms year over year. These companies have started, pre-pandemic with really good foundations in their fundamentals, and that's continued. So the resiliency of the economy, the strength, is actually the story when you see those tight spreads. What we focus on at BondBloxx is your ability to trade or your ability to access different points of income for risk across all the asset classes in fixed income.
Well, talk to us about flows in out that you've seen maybe as you wrapped up the end of last year, and then what you've seen as we kicked off 2026. As we kid, was it Mike who said that folks have been saying it's like already felt like a decade here in 2026? So give us a little comparison.
Yeah, I think 2025, more record years. In my space, in my industry, ETFs are an incredible tool for people to access fixed income markets. It just continues to grow.
But where did you see most of the money coming in last year? And then what's changing this year?
A ton of strength. It's sort of a familiar story. A ton of strength in shorter duration assets. People look for, the most attractive yield and risk combination they can. And shorter duration has been a huge category for ETFs, and it continues to be so. Really strong growth in corporates. I think your previous two commentators talked about how, towards the middle and the end of the year, people were still looking at the strength of corporate debt. In ETFs, it was the same story. And then we're seeing on our desk, we talk a lot to clients about public versus private debt and how to access that. So a lot of conversations, a lot of interest in how to complement existing bond portfolios with other sources of yield or looking for a way to enhance yield.
On the public side, the 10-year yield getting our attention, at least today, 4.29, where it is right now. You were shocked to see it that high.
Well, hitting 4.3%, right, on the 10-year. I was a little surprised. I mean, it could be 5%, and we have, but I was kind of surprised.
Yeah, the recent move higher that we've seen. Why has that been?
I think that, in all of these bouts of volatility, again, as we've looked over the long term, we've seen the 10-year approach 5% a few times. And it just represents the concern and the look, and, hopefully structurally the yield curve is changing towards rates being higher on the long end and shorter on the short and lower on the short end.
Which makes more sense logically, but you kind of get in terms of the short-term volatility that we continue to see, whether it's White House strategy, that is certainly upending.
Yeah, I mean, that is embedded. There's going to be, the tariffs are now embedded in the outlook in 2026 for investors. Volatility is always on now. And in the equity markets, what we like to call people's attention to is that a year like last year, if you aren't looking at fixed income, aren't looking at bonds and how to add more income into your portfolios to offset volatility, like you're missing out on these huge cushions.
Which was I feel like it's been the talk for the last year or so, or a couple of years, right? Where you think about what you can get on a U.S. Treasury, right, in terms of yield and return, and lock it in. Like, why wouldn't you? Especially if you're thinking longer term. A lot of your offerings, obviously, are within the U.S. Treasury market. You guys do some emerging market, right?
Yep.
What kind of activity have you seen? Right now I'm looking, I think 5.2.
So emerging market as a category in fixed income was the best performing category across fixed income last year. So a lot of interest in dollar denominated debt. And then also just getting non-US exposure was a trade last year. So what we think is important across fixed income is just understanding how you position your bet or how you position the way you think about that. And one thing about emerging market debt is it's typically very, very long dated debt. So there's a implicit two things going on. There's a relationship to the US dollar, and then there's also just the duration risk in there and interest rate risk. So what we try to do is update that space because people really do want to be shorter. And that's something that I think.
So it's active in terms of the change, in terms of composition?
No, it's an index fund, but it's just a shorter duration.
Okay.
And I think that appeals to people to think about, how do you think about a 40-year exposure? And should you be dialing that back in these markets? this is a simple 1 to 10 year exposure, and I think that's what's going on in fixed income markets as they relate to equity markets in your portfolio. Is now people really understand the maybe pain of interest rate risk and what can happen when rates zoom up, and what you're anticipating for this year if rates continue to go down. But we think that's going to be very moderate this year. We're
going to be speaking with Emily Griffeo, Bloomberg News cross-asset reporter, in just a few minutes, and she's written a lot about ETFs and how competitive the space is. I mean, it's just, I don't have to tell you or anyone watching or listening, there are so many ETFs out there. Do you plan to launch any new ETFs this year?
Yeah, we have some in registration.
Where's the white space? Like, where are the areas where that haven't been covered?
Well, I think like a big innovation from last year was private credit. And Emily's written a ton. Emily's written a ton on private credit.
I knew that's where you were going.
You know, and the reason is because ETFs tend to touch places that you need more transparency in, you want to have access in, and liquidity. And so those are the spaces that people put time and effort in terms of innovation. And I don't think that that's done. I think that the important work in how you can access alternative yields, alternative returns, is important to ETF investors, because ETFs are used in big, broad swaths of wealth portfolios, and they need to be more precise. Markets are more precise. The modern markets are more precise. And so having an ability to add private credit has been the talk. She's written a lot about it. Is it private credit? Is it not private credit? Our private credit product, PCMM, was the first to give you access to middle market exposures, and completely. So it's a pure approach, and that's what clients are really buzzing about when we're talking to them about what to do next.
Am I right in terms of assets? About 187 million?
187 million, yeah. And it's surprisingly, that's the leader in the category in terms of adoption. And that's sort of, I think, the next frontier is improving people's exposure to that in their portfolios and improving their perception of what is in a private credit ETF.